When you think about the fall of Rome, what's the first thing that pops into your head? Probably barbarians at the gates, right? Maybe some gladiators, epic battles, or even a little bit of palace drama with a hidden vial of poison. But what if I told you the weapon that really brought the empire to its knees wasn't a sword at all, but a coin? See, empires don't just get conquered. A lot of the time they rot from the inside out.
So, let's really dig into this, because the story you hear in school barely scratches the surface. We're going to look past all the battlefield chaos and peek inside the imperial treasury to answer the big question. What was the fundamental weakness that made the entire Roman world so incredibly fragile?
And here's the answer. It's as simple as it is shocking. Long before the last Roman outposts were overrun, the empire had already sabotaged its own foundation by destroying its money. It's a story about a slow-motion financial poison, and, as you'll see, it's a lesson that is more relevant today than you could possibly imagine.
Okay, so to understand the fall, you got to start with the rise. And for centuries, the engine of the Roman world was this little thing right here, the silver denarius. I mean, this was the US dollar, the euro, and the yen all rolled into one. It was the trusted, stable currency that fueled trade all the way from Britain to the deserts of Persia.
Now, back under Emperor Augustus, right at the dawn of the empire, the denarius was about 95% pure silver. Just think about that for a second. This wasn't just a token or a promise. Its value was real. It was tangible. It was universally understood. You could literally feel its worth in the palm of your hand.
And that's the key, right? The coin's value was directly linked to the power and the stability of Rome itself. As long as people believed in the empire, they believed in its money. It became the ultimate symbol of trust in the entire system.
So, how did it all go so wrong? Well, running a colossal empire is unbelievably expensive. You've got massive armies to pay, giant walls to build, and constant wars to fight. And when the tax money just wasn't enough, the emperors found let's call it a sneaky way to pay their bills.
They started doing something called currency debasement. And this is the crucial part of the whole story. Instead of raising taxes, which everyone hates, they'd melt down old, pure silver coins, mix in cheaper junk metals like bronze or copper, and then mint a whole bunch of new coins that looked the same, but were worth far, far less. It was basically a hidden tax, a secret way of stealing value from every single person who used the money.
And just look at this timeline. The numbers are just jaw-dropping. It starts at a solid 95% silver under Augustus. Fast forward about 200 years and boom, it's down to half. And just 50 years after that, it's less than 5%. The denarius had become a worthless bronze slug with a thin silver coating. The scam was out in the open for everyone to see.
And this kicked off an absolute death spiral. First, the government makes cheaper money to pay its bills. But then, because there are way more coins chasing the same amount of goods, prices for everything go through the roof. That's inflation. Pretty soon, people realize their money is becoming worthless, and they lose all trust in it. And what does the government do? It panics and does the only thing it knows how to do. It prints even more worthless coins, making the entire problem worse.
Now, this wasn't just some abstract economic problem. It had devastating real-world consequences. The currency collapse directly led to one of the most chaotic periods in all of Roman history. We are talking 50 years of near-constant civil war, plagues, invasions, and a total breakdown of trade and society. The empire was literally unraveled. In a moment of sheer desperation, Emperor Diocletian tried to fix things with brute force. He issued this thing called the Edict on Maximum Prices, which set a legal price for everything from wheat to wages. And if you violated it, the punishment was death. But here's the thing. You can't command value into existence. The edict was a complete and utter catastrophe. It just created huge black markets and basically destroyed whatever was left of the official economy.
So why does any of this matter? It's a 1700-year-old financial crisis, right? Well, because Rome's collapse wasn't a one-time thing. It was a blueprint. It was a pattern of financial self-destruction that governments have repeated over and over again throughout history, right up to this very moment.
Just look at this table. The pattern is, well, it's disturbing. Look at the columns. The government action is always the same. Create more money out of nothing, whether it's by mixing in cheaper metals or just firing up a printing press. And the consequence? It's always the same too. The value of that money gets destroyed. Rome, Germany, Zimbabwe. And just look at that last line. The same process is happening right now, just in slow motion. If you want to see what this looks like when it hits the extreme, just check out Germany after World War I.
A single loaf of bread that cost 1 mark before the war cost 200 billion marks by 1923. I mean, can you even wrap your head around that? People were literally using wheelbarrows full of cash just to go buy groceries. Their entire life savings were wiped out basically overnight.
You think that number's crazy? In 2008, Zimbabwe hit an annual inflation rate of 89.7 trillion%. That is a number with 21 zeros after it. Prices were doubling every single day. The currency became so useless, they eventually just gave up and abandoned it entirely.
Now, I know these seem like extreme, far-off examples, but the same underlying process is happening as we speak. It's just not as dramatic as a wheelbarrow full of bills. See, in 1971, the US dollar was officially disconnected from gold. It became what's called a fiat currency, which means it's backed only by our government promise, not a hard asset. And since that day, it has been steadily hollowed out. The dollar in your pocket right now buys over 85% less than it did in 1971. Sound familiar? It's the same story as the denarius.
So, no, this is not just a history lesson. This is a recurring pattern that directly affects your savings, your salary, and your future. Understanding what happened to Rome gives you a lens to see what's happening in our own world much, much more clearly.
So what should we take away from all this? There are really 3 big lessons. First, inflation isn't like bad weather. It doesn't just happen. It's a policy choice. It's a silent tax. Second, real wealth isn't just the cash in your bank account. It's tangible assets, things that hold their value when a currency fails. And third, maybe most important, never ever take financial stability for granted. You can bet the Romans did, right before it all fell apart.
And here's the thing that makes our situation today completely unique. Back in Rome's day, it was one empire. In Weimar Germany, it was one nation. Today, for the very first time in human history, the entire global financial system is built on the exact same principles that led to those collapses. Currencies backed by nothing, record-shattering levels of debt, and a universal reliance on printing money.
And this brings us to the ultimate question, doesn't it? Because money is more than just paper or numbers on a screen. It's a social contract. It's a form of trust. And when that trust dissolves, when the money stops feeling real, what exactly is left to hold society together? The story of the Roman denarius is a powerful warning ringing down through the centuries. It teaches us that financial integrity isn't just a nice idea, it's the bedrock of a stable civilization. The players change, the technology changes, but the fundamental laws of economics, they don't. They are absolutely unforgiving. So the question isn't if this pattern will play out again, but how we'll be prepared when it does.